This is Fintech Insider News. This week, unions warn that big banks should brace for job losses to artificial intelligence. Atlantic Money is poised to challenge Swift's international money transfer network. We speak to the CEO. And OakNorth secures regulatory approval to market its products in the United States. We discuss all of these and much more on today's show.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Hello and welcome to episode 893 of Fintech Insider. I'm Benjamin Ensor, Director of Research and Strategy at 11FS. I'm joined this week on Fintech Insider News by my co-host and two guests who are going to help me break down the biggest stories in the past week in fintech and financial services. So firstly, I'm joined by my co-host and 11FS colleague, Nadine Timmer-Bodenstein, Product Lead at 11FS. It's great to be hosting the podcast with you, Nadine. I always look forward to that. What have you been up to since we last spoke on Fintech Insider?
Thanks, Benjamin, and it's great to be back. I was actually just trying to think when I was last on it, and I think I've had 2 holidays since then, which sounds quite greedy. So yeah, I've been making the most of the summer. My husband's parents came over from Cape Town, so we were able to show them a bit of the UK, and then I also had a family holiday in Portugal with my family. So I have very much just been enjoying my holidays, really.
Wow, fantastic. Lucky you. Up next, we have a Fintech Insider debut for Neeraj Baid, CEO of Atlantic Money. Welcome to the podcast, Neeraj. Can you tell us a little bit about what you're working on at Atlantic Money? But we will obviously come on to it a little bit more in the podcast.
Yeah, I'd love to. And thanks again for having me. I'm excited to be here. So we started the company a couple of years ago in 2020. We wanted to build simpler and more elegant financial services than what you find anywhere else. And we wanted to bring about what we felt is a second wave of fintech disruption. So when we compare ourselves, we're comparing against not banks, but the first generation of fintechs, all the big names that everybody knows. And we started with money transfer, which is a place that we thought had considerable opportunity for innovation. And we ended up building a product customers love, and we're really proud of that. So today we're going to talk more about portals, which is a new feature that we're adding, which is going to challenge Swift directly in a way that we haven't seen in the industry so far. So really excited to talk more about that.
Looking forward to hearing about it. And in a return to Fintech Insider, we have Aditi Subbarao, Strategic Partnerships Lead at Instabase. It's really great to have you back on the podcast, Aditi. Thank you so much for joining us. For those of our listeners who missed the previous episodes, can you let us know a little bit about what you do, please?
Absolutely, Ben, and it's great to be back. Thanks for having me. I'm Aditi Subbarao. I lead strategic partnerships and financial services at a company called Instabase. Our mission is to use generative AI to help turn the world's unstructured data into insights. And it has indeed been a very active space over the last few months. There's unfortunately not been a summer lull. There's been a lot of sunshine, though. So we've been working hard to adopt new technology and help our customers leverage that in multiple different places. And I'm sure we'll be talking a bit more about that today as well. Great to be back.
Indeed, it's pretty much our first story. So let's get cracking. So our first story is that unions are warning that big banks should brace for job losses to AI. This was reported in the Financial Times, among others. So Accord, which is the UK's union for bank workers, has warned that banks, insurers and accounting firms need urgently to reskill up to 2.5 million British staff to avoid sweeping job losses to artificial intelligence. As many as 54% of banking jobs could be at risk from automation, and 48% of jobs in insurance. The UK's new Labour government is reportedly working on some new AI regulation, but unions fear that it will not go far enough in tackling job losses. Meanwhile, Klarna has confirmed that it is gearing up to cut its workforce by about half as it automates more and more of its marketing and customer service functions with AI. Klarna's CEO told BBC Radio 4 that AI will have a dramatic effect on the workforce and that politicians should consider new kinds of financial support for the public. So, Aditi, I'd love to start with you first. What do you make about these warnings? How worried should people in financial services be about losing their jobs? Is it right that financial services is the industry that's perhaps most vulnerable to job losses to artificial intelligence?
Financial services is definitely one of the biggest areas of application for AI. So McKinsey had put together a report which came out earlier, which said that as a whole, the advances in AI and specifically generative AI is likely to impact the economy by anywhere between $2.6 to $4.4 trillion. Now, to put that in context, the UK GDP is $3.1 trillion. And of those benefits, banking is likely to be by far the largest industry that benefits from this, with anywhere between $200 to $340 billion worth of increase in income and revenues coming from AI adoption. Now, what that means is if there is benefit to be had, there's also changes that will need to be made. And therefore, coming back to the story of job losses, the more applications, the more adoption, and the more efficiencies that we see manifesting from the use of AI, the more change there's going to be, not just in people's jobs being replaced by AI, but also in what jobs need to be done. So I think, yes, people in banking and FS professionals should be concerned about what impact their job is going to have from AI, whether that is positive or negative. The same goes for each one of us, irrespective of the industries that we work in, but there is definitely a high level of concentration of those applications, both in the financial services and the insurance space. So a similar report says that within insurance, we're likely to have about 48% of jobs affected by AI, more than 50% in banking. It's actually very interesting in how and where those applications are happening. So having been working in the field of AI for almost 4 years now, we've seen a decided evolution in what AI can and cannot do, and therefore what jobs it can or cannot eliminate, if you will. And what happened historically is, say, up to 2 years ago, most of what AI could do was essentially automate very descriptive, very repetitive processes. So if you know exactly what had to be done, it was kind of like programming a robot, but just a far more intelligent and a far more adaptive robot. So it was different from RPA in the sense that it could tackle some variability, but it was still a deterministic process that was defined. And therefore, the driver for banks wanting to use AI was predominantly process automation. This came in places where they just did not have enough people to do it. So if you remember what happened in the mortgage markets 2 years ago, banks couldn't hire skilled underwriters fast enough. And therefore, they went to technology to say that I can't just get people off the street overnight when demand rises. So therefore, can technology do something for me? The same thing happened in the space of insurance. You need to process claims rapidly, fast, accurately as they come in. You can't just ask a customer who's just had an accident to wait for 3 days to find out what happens to their claim. So capacity constraints used to be the primary driver, followed obviously by costs and other benefits. However, and this is where we come into the generative AI era, what has happened over the last couple of years is that AI is not just capable of automating processes, it's capable of actually creating intelligence and actually providing insights. And therefore, the lens in banking has shifted from just mundane, repetitive, kind of busy work, if you will, to tasks which were historically considered very human-centric. Relationship management, front office people, bankers, advisors, investment professionals, all of them are now seeing AI come into their world because AI can actually look at data, derive actual insights from that data, which will then affect work. So I do think the spectrum of what is affected by AI is massively widening. It is interesting to see that while tasks that fell into the first bucket of operational repetitive tasks can absolutely be automated, and people doing those are going to have to change and upskill and do things differently. But in the second bucket, where it is not so much operational work, it is more knowledge work, we're seeing AI being used far more to augment those processes and generate growth. So where banks want to onboard new customers, or where there's an entire market segment that you didn't even know how to access before, or where you are now finally getting to serve your customers with much more personalization. All of those are areas where AI is helping. So I think from a jobs perspective, the way I look at it is change will be everywhere. Losses in some places, gains in some others. But we absolutely need to be thinking of what that change means for each and every job, and how do we train and upskill and divert resources from where they are now to where they need to be for the future. Wow, that was long, but I'll stop there.
Nadine, I'd love to bring you in. Did you agree with Aditi? Because the Klarna sort of was implying that a lot of the jobs that Klarna was replacing with AI were effectively sort of contact center jobs, as they were using chatbots to handle more and more customer service. Some of the marketing jobs, as they were getting better at sort of automating marketing, personalization, as Aditi was saying. But what Aditi is saying is actually in that second bucket is actually pretty much every job in financial services, in insurance, in investment management.
Yeah.
Do you agree with that?
Yeah, absolutely. I think, gosh, Aditi raised so many good points. I'm trying to remember which ones I almost wanted to respond directly to. But I suppose that on that question to begin with, and Aditi kind of summarized it very well, I read a report by the Institute for Public Policy Research. Granted, their report covers kind of all industry in the UK. It's not just focused on the financial services industry. And they're actually predicting that the total job loss is around 8 million. But when they speak about what types of jobs are most at risk, they speak in terms of the first wave and the second wave. So quite similar to what Aditi was mentioning there. And the first wave is around jobs that are, or rather tasks that are more focused on repetitive kind of daily administrative tasks. And they predict that about 11% of those tasks were currently at risk. But when we think about moving into the second wave, as Aditi mentioned, as the generative AI technology gets more complex itself, as it's able to perform more tasks, that figure of 11% jumps up to 59%. So you can see the impact that this will have over time as the technology grows and gets smarter itself. And I think, so I guess back to your point, Benjamin, I think at the moment, I don't actually know exactly where we are in wave one or wave two or somewhere in between. I'm not an AI expert from that perspective, but I think it provides some context to what Klarna was saying around how they are even anticipating some of the job losses or layoffs that are going to happen within their own company being more focused on perhaps more human-centric or complicated tasks around marketing. And that makes sense as well, given some of the points Aditi raised. We're not this technology is not anymore just automating basic input functions. It's actually able to start doing things around personalized content and recommendations at scale. If we're thinking in the context of marketing, the AI can analyze vast data sets of customer data, including things like your browsing history, your purchase behavior, your preferences, to deliver that truly personalized experience. Predictive analytics, we speak about how perhaps people in analytical roles are those who are more at risk, and it makes sense because AI again can analyze vast historical data sets to predict future customer behavior. So you can see perhaps where before you might have had a need for 3 individuals in that marketing team looking at these different areas. Perhaps now it's one person in that marketing team analyzing the outputs from the AI and making decisions. So I think it's really interesting. The final point I'll make, and this is also something that Aditi touched on, I always try to adopt or get both sides of the story and kind of create that balanced view. And so I also read 2 or the summaries of 2 articles. One had been written by analysts at Deutsche Bank, and one had been written by analysts at, I think it was Morgan Stanley, actually. And they basically came to the conclusion from their research that the net difference will be 0. So whilst AI is going to result in many, many job losses, it's also going to create many, many jobs. And they kind of both independently based this research on examining the history of technological advancement on employment. And their conclusion was essentially that on the whole, AI is going to complement jobs as much as it replaces them. So I think that's also just something to bear in mind when thinking about this.
I'd love to bring Neeraj in just quickly on what you thought of the comments from Klarna's CEO. Is he sort of giving everyone fair warning of what's going to happen in the industry and that lots of financial services companies maybe will just need fewer people, or is he maybe trying to spin his company as kind of sort of AI centric ahead of an IPO? What did you think of his comments?
Yeah, I think he's probably doing a little bit of both of those things, and at least one more thing, which is using this trend as an excuse to do something he wants to do anyway. I think we see that as a common tactic that companies use. Right, this is not an AI specific thing, but there's a trend going on, and the company overhired at some point, or the company wants to cut costs in customer service and is using AI as an excuse to solve those problems and solve it from a PR perspective. So I think we need to. I think there's part of kind of peeling back the curtain to see what's really going on under the hood in those types of public comments, especially when they're so one-sided. But I'm sure the other is too. There is real value in this technology, and there is real value to his stock price if he can position his company as a leader in this space. But I think there's also a bit of peeking behind the curtain a little bit.
Yeah, I suppose CEOs have to be political sometimes in how they lead. Okay, I would love to keep talking about this for another hour, but we need to move on to our next story. But fascinating insights. And I think maybe we should all be thinking very hard about our individual roles as going forward as AI takes on more and more of what we all do every day. Okay, so our next story is that Atlantic Money is announcing itself as a challenger to SWIFT. So the London-based fintech has announced ambitious plans to take on the world's most comprehensive international payments network with its new solution called Portals. So SWIFT, meanwhile, has been in place since 1977 and is so baked into the international financial system that Russia's exclusion from the network was a key part of the sanctions introduced on Russia following its invasion of Ukraine. The news from Atlantic Money comes in the same week that Revolut announced its own cross-border payment solution in partnership with Visa that it claims will enable international transactions in just 30 minutes. So we're lucky enough to have Atlantic Money's CEO, Neeraj, with us right now. So Neeraj, can you tell us a little bit more about Portals? Who's it for, and what's the need that you're addressing with it?
Yeah, absolutely. So today we have the core Atlantic money service, the one that has been in the marketplace for a couple of years now. And it's a flat fee money transfer service. So it's the only one of its kind in the world, right? So we only charge customers a flat fee and they get the live exchange rate straight from the interbank markets. So that's something we're really proud of. Customers love it. People save a lot of money using that service. So we're really proud of it. So we looked forward and thought, we should do something. We should push on product. We should find new and interesting things to do with the product and solve new problems for people. And we wanted to specifically ask the question of, how do we make the cross-border experience more convenient? How do we make it even better? Everybody's got an app. You can log into the app and make transfers. That's like pretty commonplace. But how do we push that even further? And especially, we wanted to focus on the customers for whom our service is the most important, right? These are the people that use our service the most and for whom our service and money transfer more generally holds an important part of their financial life, right? So for them, money transfer is an important part of their financial life. So these are people that are moving money often on a recurring basis. And we found that over 90% of recurring customers are transferring to the same recipient over and over, right? So they're basically sending money to the same place over and over. And we wanted to make that experience specifically better because there's so much repetition going on there. So we came up with this idea, which is portals. And portals create a direct link between your local bank and your foreign bank. So today, if you wanted to make a money transfer, our app sits in the middle, right? So you have to come to our app, set up a transfer, then go to your bank and fund the transfer, right? So our app is kind of this intermediary. And with portals, we wanted to make that easier. We wanted to make it possible to make a direct transfer from your local bank to your foreign bank. So I'll explain how this works. So the way that portals works is, let's say you want to send pounds to dollars. So when you say that you want to send pounds to dollars, we'll give you a unique UK local sort code and account number. Those are things that anyone is familiar with. And then anytime you send pounds to that specific sort code and account number, our system will pick it up and will automatically convert it to dollars and send the dollars to your US bank. All right, so all you did now as a customer is you made a local pound to bank transfer from the UK bank that you already know and trust, and US dollars appeared in your US account. You didn't have to use any of their apps. You didn't have to take any of their steps. Like money shows up, money leaves your UK local account and it shows up in the US. And that's using that's taking our network into account, right? So you're not using Swift to do that. You're using our network. So you're getting a much better price. Your transfer is potentially moving faster, and you're getting the lowest fees in the marketplace. And that's a magical experience that we're happy to turn on for customers.
So to do that, presumably you must be operating bank accounts at both ends, right? So in the example you gave of pounds to dollars, the customer must have you must be running an account in sterling in the UK, and then you must be running a bank account in Canadian dollars or American dollars or Singaporean dollars or whichever dollar country it's going to, right? So presumably you've got some partnerships with banks to set up those accounts. Is that correct?
Yeah, for sure. We work with a variety of banks around the world to set up our network. So we, of course, run our own network, and then we have an app that sits on top of it. So with portals, you can access the network without the app, and that's what's really interesting, right? With Swift, there's no Swift app. You just access the Swift network from your bank. And similarly with portals, you don't need the Atlantic Money app to access the Atlantic Money network. And we think that's a really interesting sort of conceptual difference. That portals enables. But to answer your question, yeah, we have partnerships with banks. We have partnerships with liquidity providers. These are the same liquidity providers that, major institutions that everybody knows work with. So our customers are getting access to the best interbank liquidity available in the world. And we're really proud to do that. I think we're the only company probably that gets you direct access to that liquidity. Everybody else kind of makes up their own exchange rate and does some stuff, but like this is the market where everybody else transacts, and that's where our customers are transacting. And we're really proud to give customers that access.
I want to ask you one more quick question before I bring Nadine and Aditi in. If you're doing this a really low cost or a fixed fee, and it's a really great product, how on earth are you making any money here? I mean, it sounds great, but how on earth are you making money here?
Well, our costs are much lower than that. The costs that you see are a couple of things. But I think what's probably most interesting is the way that our customers behave. because we're building products for this specific set of customers that uses money transfer often, the amount of money that we make per customer is substantial because these people, they know what they're doing. They keep our operational costs low because they're savvy. And because we have lower operational costs, we're able to pass that along to customers in the form of savings, in the form of a lower fee. And then we're also, we don't need to mark up the FX rate, but the FX rate is also not a cost center for us, right? Because our customers are going to just directly transacting on the market. So that's not a cost center in a way that it might be for other businesses that need to recoup that cost by marking up the exchange rate. So we've got a really efficient FX network that customers can tap into. So from there, our costs are then, we've got low operational costs, basically no FX cost. So finally, what we're looking at is local bank transfers, which are extremely cheap. So our margins on that £3 are actually quite high. So we've got plenty of margin left over to run a profitable business, and we make money on our transfers. So the business model ends up working out.
Nice. I actually wanted to jump in with a question because I always love digging into the customer experience in a bit more detail. So, Neeraj, I'm a Barclays customer. I've got my Barclays app. Let's assume I also have just downloaded Atlantic Money. So I've got that and I want to send money to my, Wells Fargo account in the US. Do I initiate this entire process through my Barclays app? Or I guess I'm trying to understand what is my interaction with Atlantic Money during this process?
Yeah. So let's say you just downloaded the app. You'll use our app for setup. So you'll sign up, make an account, add your Wells Fargo account as a potential recipient. Once you add your recipient, every recipient gets a set of portals. So if you wanted to send pounds to dollars in the US dollars, your Wells Fargo recipient is going to have a GBP portal, so a pounds portal, which is a sort code and account number. You take the sort code and account number. It's unique to Wells Fargo. So you can take the sort code and account number, save it in Barclays, and then you're done with the app, right? You could delete the app. Maybe not delete the app, but you could kind of stop thinking about the app, right? Now you've got the sort code and account number. It's saved in Barclays. Anytime you want to send money to your US bank, all you do is you send pounds to that sort code and account number you saved in Barclays, and dollars are going to show up on the other side. So for that whole transfer experience, you don't need to use our app. It's just a setup at the beginning, but the transfer experience is completely without our app. And that's what we're really excited about.
And I mean, that is brilliant because effectively, this is my very basic way of summarizing it. The portal is the creation of a new UK sort code and account number, but that sends money to the location which you want it to go to. And I think, I've sent money back home to South Africa. I'm sure anyone who does it. And actually, that was going to be another question of those, 90% of people that you said make very consistent payments. I'm wondering if the biggest reason is remittance to kind of send back to family in a different country, because that's certainly the biggest use case for me. And, when I've used different apps before, it's always a bit of a mission because you have to download the new app, you then have to look at it, then you're sending money from here to there, and there's so many processes. Whereas what you've created is a single setup, and then you're done. You're good to go. You save it as your beneficiary. You give it the name that you'll remember in the future, and away you go. Which sounds really amazing. So congratulations.
Thank you. Yes, we're excited to get it out the door. I've been using it for a little while, and I enjoy it.
So, having spent almost 6 years in the field of FX cross-border payments myself, I think this is a fantastic idea, Neeraj, especially the fact that the FX rate isn't a cost. You're just passing on the direct rate that you're getting. The area that I'd be very curious to find out more about is, tell me a bit more about how you manage this in restricted markets where there is no direct convertibility of currency. And secondly, do you see a marked difference in the usage and maybe currency corridors or patterns for retail, which, like Nadine said, might be heavily focused on the remittance basis versus SME and corporates? And are you even planning to grow out that side of the business? Because I think if you could extend something like that into the commercial and SME space, then that will be phenomenal.
Yeah. For sure. So to answer your first question, we operate in Indian Rupee, which is, I'm sure, one of the markets that fits the category you're talking about. We work with local banks for that one. So to convert Indian Rupee, as I think it has to be. There's obviously some restrictions. It's not as liquid of a currency. So you need to work with local banks, which we do. We, same as always, pass through the best rate we can get to customers, and yeah, they're on their way. So it's from that perspective, like, we have different partners, but structurally the idea is the same, where we're passing through the best rate that we can find, and customers convert at it, and they can freely send into the country. We don't allow Indian Rupee on the outbound, right? There's a whole different set of complexity that comes with that. But we do Indian Rupee on the inbound, so delivering into India, which our customers are very happy to use and can use, like, pretty freely, I would say. In terms of your second question, so we serve both individuals and businesses. We do see different usage patterns. We see different use cases. Businesses are doing a lot of cross-border invoice payment in particular. It's a common use case. We see a lot of global treasury management for enterprises. A lot of them have, like, multi-currency bank accounts, but we'll see, like, payments coming in from one bank and then going back to the same banking group. So they're like, instead of using their own bank's FX, which might be marked up by 3%, 50 basis points or whatever, they'll just run, like, 50 grand through Atlantic Money and pay almost nothing for it. And we're happy with that. Like, that's a perfectly good transfer for us. And they save a whole bunch of money. So, yeah, we see treasury management, we see invoice payment. You'll occasionally see, like, the contractor payment, although that one's less so than the first two. But there's definitely different use cases among the two groups. And everybody's gonna have access to portals, by the way, individuals and businesses. So everybody's gonna get it.
I do have an add-on product idea for you in the field of, like, multi-currency cash concentration and netting effects. But yeah, we can talk about that more offline.
Love that. Sounds great.
This is absolutely fascinating, Neeraj. I'd love to hear more about it, and I'm sure some of our listeners would too. I mean, we're out of time because I really want to ask you whether you're really competing with Swift or whether you're more competing with the sort of Wises and Revoluts and so on. But it sounds like you have got a fair amount of corporate business on your platform already, not just retail business. But I think we're going to need to move on, unfortunately. So we'll have to get you back on the show to tell us more on future episodes. So we'll just take a quick pause here, and we will be back very shortly.
This episode is brought to you by Microsoft Azure. Turn your ideas into reality with an Azure free account. Get everything you need to develop apps across cloud and hybrid environments, scale workloads, create cloud-connected mobile experiences, and so much more. Discover what you can create with popular services free for 12 months. Learn more at azure.com. That's AZURE.com. And sign up for a free account to start building in the cloud today.
This episode is brought to you by Shopify. Forget the frustration of picking commerce platforms when you switch your business to Shopify, the global commerce platform that supercharges your selling wherever you sell. With Shopify, you'll harness the same intuitive features, trusted apps, and powerful analytics used by the world's leading brands. Sign up today for your $1 per month trial period at shopify.com/tech, all lowercase. That's shopify.com/tech.
Welcome back. Before we dive back into the rest of the show, we want to tell you about our latest Fintech Insider Insights episode. This time, we're discussing the fintech sector in India. I was privileged enough to be with two fantastic experts to explore the Indian fintech firms that could be poised to go global. We looked at some of the challenges and opportunities posed by a market of 1.4 billion people and the vast digital infrastructure that's making it possible to take financial services to so many people. It's a great conversation with two fantastic guests, available now. Just head to the podcast below this one in your feed. Okay, so now back to the news. So our next story is that OakNorth Bank has secured approval to market its products in the United States. The London-based digital bank has overcome a key regulatory hurdle in the United States market, having been authorized to open up a representative office in New York. This means that OakNorth can actively market to US business customers, rather than just passively accruing American customers. And this is ahead of a possible stock market listing. It's the latest in a steady stream of successes for the digital bank, which posted an £187 million profit for the 2023 financial year. Now, OakNorth looks set to make a more substantial push into the US small and medium-sized business market, which it believes remains underserved by American banks. Now, we spoke to Valentina Christensen, Corporate Affairs Director at OakNorth, to find out a little bit more.
Thanks very much for giving me the opportunity to discuss this exciting update from OakNorth, a really significant milestone for the team. We began lending in July last year. In the last 12 months or so, we've done about $600 million of lending in the US. By comparison, in our first 12 months, actually our first 15 months in the UK, we had done about £300 million of lending. And obviously that was when we had a full UK banking license and were able to do marketing. So the fact that we've been able to do $600 million without a US banking license and without being able to do any marketing, I think really speaks to the demand there is in the market for OakNorth's proposition, but also the gap that's been left by the failure of several banks over the last 18 months in the US, which has obviously meant that lower mid-market businesses have less choice in terms of who they go to for their capital needs. And obviously OakNorth has been here to help to fill that gap. It's been really, really positive so far, and we hope to really build on these numbers in the months to come, and hopefully have some even bigger numbers to report on in another year.
Nadine, we've seen plenty of European banks and indeed other fintechs sort of going over to the United States and launching and then finding it's quite a hard market. It's quite difficult. It's quite complicated. Is OakNorth going to be different here? Have they got something that's going to make them more successful than some of the other European firms have been in the American market?
I certainly think so, for a number of reasons. I think, firstly, just drawing on some of the figures that were mentioned there, and also that in the article that was shared, OakNorth says that without doing any marketing, they were able to do 3 times more business in the US over the last year than they originally anticipated. So I think, the first response is the numbers speak for themselves. In terms of what is the biggest driver of their success, I think what OakNorth has always done incredibly well here in the UK, and they're going to continue doing that as well in the US, is that they have been laser focused on a single underserved portion of the market. And in this case, it is those, SME businesses. And thinking about the SME landscape in the US, these kind of firms make up a quarter of all SME turnover, the type of firms that OakNorth is targeting, even though they represent just 3.4% of all SMEs. So I think what they've done really well is to be laser focused on a segment of the market that has previously been underserved, by providing them with a customer experience that is much better than what they're used to, much more digitally enabled. Previously these types of businesses are probably waiting 3 weeks for a lending decision from a large bank with a suboptimal service, whereas OakNorth can come in using the AI and automation that they have, complete the same type of complex loan processes in a matter of weeks compared to the many months that it would have previously taken. So I think what they've done is really smart by staying focused on that initial customer segment, by delivering a differentiated proposition to a section of the market that has previously felt let down by the banks that they have. And as we know, for these smaller businesses, that quick answer when it comes to lending decisions is really important. They need to maintain momentum. They need to know whether they're going to have the capital injection required to do whatever it is that they're looking to do. So I think it's really exciting, and I really wish them all the best and hope that they do continue to be as successful in the US as they have been over the last 12 months.
What did you think, Aditi? I mean, Instabase is an American company. Do you think OakNorth is sort of showing other European companies how to succeed, how to be more successful in American financial services?
I would say yes. And in fact, I'm going to show my bias all over again. But one of the reasons that OakNorth has been so powerful in that outreach and also in the UK is that they are extremely astute in their risk management and their underwriting practices. So they have built this really advanced, really developed risk scoring and underwriting platform in-house, which has been a very strong differentiator for them. And when you think of the biggest hurdle that large banks have in lending to or underwriting small businesses, it is basically being able to assess the risk and the credit correctly. It's the reason why SVB was so big and was had such a big monopoly in the client base it served, because none of the large banks either knew or wanted to score the risk and the credit of the people it lent to in that space. So from that perspective, I think OakNorth has definitely done a great job. And like Nadine said, they've concentrated their focus on a particular market they wanted to serve, but then taken that further in saying, we know everything there is to know about that market, and we are going to develop really sophisticated ways of managing that market the right way. So I think the most impressive thing they've done is to build out that knowledge base, use the right technology, and take those underwriting decisions very well. One of the challenges they might face potentially is that from a regulatory and even a government and organizational perspective, there is far more backing in the UK towards the SME sector. There's a lot more noise, there's a lot more programs, there's a lot more initiatives, there's a lot more investment that specifically focuses on that sector. The US, by virtue of being so large, so varied, and so disaggregated, is a much harder market to get the requisite support from the ecosystem to serve SMEs. And therefore, I believe that is the biggest challenge that OakNorth will face, because a lot of what they need to do, they will need to do themselves, as opposed to have the external system support them for it. But again, exactly as Nadine said, all power to them, because I think this is definitely something that is much, much needed in that economy.
Neeraj, we talked earlier about Klarna potentially looking at doing an initial public offering at some point, next year. OakNorth is also in a similar boat of potentially looking at raising funds through an IPO. And they've been talking about potentially doing that in the United States rather than in Europe. Do you think we're getting to the point where, European fintechs are sort of just more interested in going to America to raise capital because it's just a bigger pool of investors? It's a maybe more sophisticated pool of investors. Do we think we're just going to see an exodus of European fintechs to the North American, or specifically the United States, New York listings?
Yeah, I think the thing with these sort of investment offerings is that you have such a strong network effect of investors that are available, right? All the investors are in one place. All the big companies are in one place. So for anybody else, right, even London, which is a major global financial capital, for anyone to compete with that network effect is very challenging. And you look at the size of the US markets compared to not just any one country, but compared to the rest of the world, right? It's such a big portion of the entire global market that, I think the network effect is very difficult to beat. And I don't think it's I don't know that it's a UK specific exodus, rather than the network in the US and in New York is just that strong. And it's hard for someone to compete with. And frankly, I don't know that Brexit is doing the UK any favors on this sort of thing. But really, I think it's the strength of the network in New York more than anything else.
I'm not going to comment on Brexit, but clearly for OakNorth, having American customers would be very, very helpful if they are thinking about having an American listing at some point down the line. Having a substantial business in America would obviously be helpful, wouldn't it? Okay, well, sticking with North America, our next story comes from the Great White North, which is that KOHO is launching tenant insurance and rent reporting solutions. This was reported in Fintech Global. So the Canadian fintech KOHO, which currently offers savings accounts and current accounts, is aiming squarely at Canadian renters. It's a rental market, like many, that's facing an affordability crisis, with urban hotspots such as Toronto and Vancouver increasingly inaccessible to young professionals. KOHO's new rent reporting feature is designed to enable healthy access to credit while building credit scores for renters. Meanwhile, KOHO has partnered with Canadian insurtech Walnut to launch a rental insurance product. Nadine, let's start with you. What do you make of this strategy from KOHO and these new products?
So one of the projects I've done since I've been at 11FS was to work with a large credit union in Canada. And I was lucky enough to travel out there to British Columbia, and we conducted quite a lot of research with our target customer base. And it was, quite alarming how many of the people we spoke to felt completely hopeless when it came to their living situation, whether that was the rental situation that they were in, or perhaps having ambitions to purchase a property in the future, but that just seeming like such a faraway goal that they could never achieve. So when I read this, it kind of really resonated with what I've heard firsthand from Canadian consumers around just the living situation, whether you're renting or buying. So I think firstly, and this is also one of the topics that came up during those interviews, was around credit building. So the rent reporting feature, just to give a little bit more detail on it, essentially what it enables is that as a customer, if you make your rent payments through the KOHO app, those payments will be reported directly to the credit bureau, which means that they will now contribute to your credit history. So you're able to actually start building up that credit score through rental payments. This is the kind of, I think, one of the first, if not the first, services of this type in Canada. So it's really brilliant from that perspective. And as we all know, building that credit history is integral for financial stability, for future wealth building, for achieving your goals. So I think that's a really fantastic feature. And I know that it would have resonated with the people that I spoke to directly in Canada. And then the second service that they've launched is what they're calling tenant insurance. So this is for emergencies, but I think what's more interesting about it is the cashback portion of it. So KOHO members who are eligible for the product and who opt in for this insurance receive a bonus 0.25% cashback automatically on all of the rent payments processed through KOHO. So you can now see how, if you've got KOHO and if you're making your rent payments through them, not only are you actually building your credit score in doing so, but you're being rewarded with that 0.25% cashback. And the cashback element is also really important, I think, in the context of Canadian culture and consumers, because that's another element that came up quite a lot during our project there and our research. Most people in Canada have some kind of cashback card, whether that's a credit card or debit card. It's a very popular form of reward, and it's something that consumers expect. So I think this just demonstrates how KOHO clearly understands their consumer very well, because they are not only enabling them to build up their credit score for that longer term financial stability and wealth building, but they're also actually rewarding customers for that positive behavior. So yeah, really, really exciting. They also have other adjacent features as part of the services, where they do kind of automatic payment processing. You can track your historical rent payment. So I think overall they've created something that's really holistic and is going to help a lot of people. And I think also make a lot of people feel less hopeless, and actually, well, if they're able to start building up that credit history and that credit score through renting, then perhaps that ambition of home ownership isn't so unachievable after all.
Thank you. A lot of food for thought in there. Neeraj, I'd love to hear your perspective on this, because it seems to me that in developed countries around the world, we have sort of increasing problem where young people, including young professionals, are increasingly getting excluded from properties in the cities because prices just sort of continued to go up and up. Do you think that's something that fintech can ever truly solve, or is it more just a question of maybe just trying to mitigate it, making it a little bit better? Do you think there's any solution? I mean, I realize we don't want to go into politics, but this is quite a big problem, isn't it, for young people all around the world?
No, it's a great question. And I think fintech can make it as good as possible. So, this fintech clearly has found some silver linings in renting. It's found a silver lining in credit score building, which is great. Like, if I can build my credit while renting, why not? It sounds great for me as a consumer if I can get some cash back sure, why not? But I think, I firmly believe that the source of the issue is a supply and demand mismatch. So I live in Tokyo, Japan, and Japan is a very different housing market compared to most the Western countries we're talking about. And there's a lot of analysis done on this, but I think part of it is around the culture around building. In Tokyo, you just build. Like, you don't, there's like the barriers to building are so low compared to what you might find in a typical Western city like the ones that you mentioned. And that contributes so heavily to the perception of housing here is so different compared to the West, and that you see different trends in pricing and different trends in affordability, and like all these things are very different. And one of the big root causes is that the ability to build new and bigger things in response to demand is much more flexible here than it is in some of the other markets you mentioned, and it has a really significant impact on the nature of the market. So yeah, I think it's just there's a supply and demand mismatch. And there's a lot of interest on either side in terms of not fixing that supply and demand mismatch, and that's, I think, where the root of the issue is. But again, like, if there's ways to make the current situation better without fixing the root, like, great, why not grow my credit score? Why not get some cash back? But it's not the root of the issue, in my opinion.
What did you think of this, Aditi?
I think this whole topic around home ownership and how the process of becoming an owner, becoming a renter, becoming a seller can be changed is so fascinating because it is so inherently linked with societal attitudes and perceptions of the home, like the concept of home. And I think, Neeraj, you brought out this really interesting point. In Japan, people think about it very differently because you can just build from scratch on a blank place. It's the same thing in India. Like, most people who can afford homes will literally just buy a plot of land and then build their dream home on top of it. Obviously, that's changing now in urban environments. It's very different in the developed world. I was stunned when we bought a house in the UK for the first time. And I was like, when was this built? And we were told sometime in the 1800s. And the bank was perfectly happy lending against that. And I was like, this is a bit scary. But anyway, so I think that is so interesting. And I often wonder whether that's also one of the reasons why we have not seen anywhere close to the amount of innovation and new ideas, new ways of doing this in that space as we have anywhere else. Like, we have one way of home buying, which is debt through mortgage. We have another way, which is kind of paying back that mortgage to get equity in it. And then we have the option of renting. But actually, there is so much interconvertibility between all of these three. Like, you could effectively turn the equity you're buying into debt. You could have convertible ways of, like, bond-based ways of creating ownership of your house. Like, there are so many different things that can be done. But I wonder if it is that psychology of society as a whole that thinks of your home as this ultimate asset which you bequeath across generations, that is in some way hampering that innovation and hampering that change coming in. So I don't know. I think it's like the next frontier of fintech change, maybe.
There's an expression in England, an Englishman's home is his castle. And I think what you're all rightly getting at is that attitudes to property are very different in different countries. And that each country needs to be looking at, are there some more intelligent or different solutions to the housing problems that many countries have? Okay, well, let's now have a quick look at a couple of other news stories that we don't have time to cover in full. And we will just, Nadine and I will just quickly summarize them. So one story that we thought was fascinating was that MUFG has invested $333 million in the Indian digital lender DMI Finance. So this capital injection comes just over a year after MUFG's last investment in DMI, when the Japanese bank led a $400 million financing of the fintech. The New Delhi-based firm, DMI, was an early entry into the Indian fintech market and reaches some 15 million customers. DMI offers point-of-sale loans to consumers through a partnership model, working with third parties such as Samsung and Google Pay. And I think this is really, really interesting. MUFG is not perhaps a household name or even a sort of incredibly well-known name in fintech, but it really ought to be because, of course, it's the largest banking group in Japan. It's one of the top 10 largest financial groups in the world. And I think they've been doing some really, really interesting investments over the last 6 months or so, maybe a year and a half, in fintechs right across Southeast Asia and now the Indian subcontinent. We're quite used to seeing Chinese firms investing in Southeast Asia and India. Really interesting to see MUFG making some really astute investments. I don't know DMI finance that well, but obviously point of sale lending is a very attractive model, particularly through partnerships. So I think this is a really interesting move, and I'm watching closely at what MUFG is doing because they're doing some very interesting deals. We got a bit used to SoftBank from Japan doing some slightly wacky deals. I think these deals could look very, very interesting. Nadine, what have you got for us?
Yes, our next story is from Sky News, and it is that Visa is in talks over a £700 million Featurespace acquisition. Visa is reportedly in advanced negotiations to take over Featurespace, which is a UK machine learning-based fraud detection company. Featurespace has raised $100 million so far, including from the late tech entrepreneur Mike Lynch. The company was founded in 2008 and it serves major financial institutions such as HSBC and NatWest. So Featurespace makes adaptive behavioral analytics software, which essentially uses machine learning to detect and prevent fraud in more than 180 countries. And I think, as expected, demand for its services have grown amid a recent explosion in financial scams, especially because they're becoming increasingly sophisticated in recent years, meaning that they're costing banks billions of pounds to refund customers. And I think what's really interesting about this is that there are clear synergies between this potential acquisition and a recent announcement that Visa made on their upcoming digital product innovations, which include data tokens, passkeys, but perhaps most importantly, AI-driven fraud management solutions. And all of these new product launches are set to launch later this year. So if the acquisition is successful, then obviously we can see how Visa will benefit massively and how there are already existing synergies between some of the products on their roadmap and what Featurespace does.
Thank you. Very, very interesting. I suspect Aditi's bursting with comments about the potential of AI, but we don't have time. And finally, we have a little story about something a little bit more lighthearted from the world of finance. This one's kind of on the edge of finance and fintech, which is that e-ticket vendors are set for a massive surge of interest in Oasis. So by the time you listen to this podcast, Ticketmaster, Gigs and Tours, and C Tickets will have sold more than 1 million tickets to see Britpop phenomenon Oasis in their first tour since 2009. So following Taylor Swift and Beyoncé tours over the past year that have been so popular that they've actually been found to be inflationary, the era of the mega tour is far from over. But with fans worried about website crashes and tickets expected to sell out in a handful of minutes, is the way we buy tickets fit for purpose? So, panel, have you had bad experiences or good experiences getting hold of tickets for big tours or festivals? Who'd like to go first?
I can jump in because I was recently, a couple of weeks ago, at Taylor Swift, which was very exciting. And I think I had the best experience in acquiring tickets for that concert, which was that my friend bought them for me. I had absolutely zero involvement in the process. I got a message from her, Rachel. She's actually a fellow product lead at 11FS. And she said, do you and your husband want to come with me and my boyfriend to Taylor Swift? I was like, yeah, sure. She's like, okay, great. We'll handle the ticket buying. I was like, fantastic. These are the dates I can do. And that was it. I just had to transfer her the money. So my recommendation is find a friend who's willing to sit on hold for hours with websites crashing to get the Oasis tickets, and then you don't have to worry at all about it yourself.
The last time I was on this podcast, we had the discussion around Taylor Swift and who's attending. And I had already confessed my complete absence of cool quotient by saying I've never been for any big concert. So I don't think I'm the right person to ask here. But yeah, I do think, again, there is this whole ticket buying process. We have people who will queue overnight in the rain to get tickets that they want for Wimbledon, for example. I'm sure there would be other ways of being able to do this rather than like refreshing your browser every fraction of a second waiting for the tickets to upload. But yeah, luckily I have never subjected myself to that.
Yes, what I was going to add is I think a lot of this what we call a bad experience is engineered. The idea around allocating a scarce resource among a lot of people is not a new idea, right? We see this everywhere. So the companies are leaving this what we call bad experience on purpose because it generates hype. And hype is good for their business. It creates this spike of energy, people waiting in line, people refreshing their browsers. Like, this is a spike in energy that's good for the event. So I think if they really want to solve the problem, there's a lot of ways to allocate scarce resources, right? You can do a market-based solution. We talked about real estate where you get high prices when there's like a big imbalance in supply and demand. You can do centrally managed allocation by random or, by application. We see that with, universities. You've got this massive demand to get into universities. How do they allocate space? By applications. Or you've got sneaker drops. Sometimes like Nike will randomly select people to get access to these shoes. People like wear their email, hopefully hoping to get picked. So there's so many ways to solve this problem, and the companies are, I think, choosing not to because they don't want to. Like they don't benefit from solving this problem, so they just don't want to do it. I think that's what's happening here.
I really like your idea of application based, and it led me to think of on our previous conversation around AI. And there's surely a way in which Oasis could analyze, use social sentiment analysis and go onto your Instagram and Facebook profile and your Spotify playlist and rank people in terms of, you are the biggest Oasis supporter, therefore you deserve a ticket over someone else. So that's quite a radical idea.
Or maybe they'll realize that all of us have heard just way too much of Wonderwall in college dormitories and don't want to do it ever again.
I quite like that thesis that this is they're deliberately creating a false sense of scarcity to try and create hype and get people bidding, because it definitely seems a very unsatisfactory way of getting tickets. Because even to your point about people sort of queuing for tickets, that's almost a better system, because as you say, the people who are real fans are really really willing to do it and willing to go through a pain because they really particularly want to see someone. Of course, the other answer is for Taylor Swift or whatever to just do even more concerts. But I mean, her physical stamina doing so many concerts is quite impressive, isn't it? And how many concerts are Oasis going to want to do if they haven't done one for 15 years? Are they really going to do enough events to satisfy all the potential demand out there? So any final thoughts on a better way of doing it, or do we think they'll just carry on doing it the same old way because it works for them?
I don't know why they would solve this problem.
Because they don't feel the pain. It's just their fans who feel the pain.
Yeah, and I think like the opinion of this is always, man, the experience sucked. But there's a satisfaction when you win, when you succeed as a customer. Like, oh, I got the ticket, I feel good about that, and I can brag to my friends that I got the ticket because I had to work so hard to get it. And I think with a lot of early fintech days, you saw wait lists everywhere. So it's a lot of the same sort of concept. And people will get upset at wait lists. And then when they get off the wait list, they're like so excited to use a product that they forget they ever had it. So that's a very common phenomenon that you would see around these like wait list type products. And I think that, again, on the surface, everybody says the experience sucks, but their actions will speak differently. So these companies they don't have an incentive to solve the problem from the way we define solving it.
One of my customer experience colleagues in the past always used to say that the people who feel the pain solve the problem, and I agree with you. There's the companies aren't feeling the pain here. Okay, well, that wraps up this week's Fintech Insider News. Thank you so much to the three of you. Where can people find out a little bit more about you and your companies? Aditi, where can people find out a little bit more about you and about Instabase?
So on the Instabase website, I would encourage everybody to go to AI Hub and try it out for yourself. It's like a little sneak peek into what AI can actually do for you. And please reach out to me on LinkedIn, which is the best way of getting in touch with me.
Neeraj, where can people find out a little bit more about you and about Atlantic Money?
Yeah, so we're Atlantic.money. That's our website, Atlantic.money. That's the entire domain. And You can find, everything about the product is there. You can sign up, get started. If you want to play with portals, that'll be ready for you shortly. And most importantly, if you want to see our comms team roasting Wise on LinkedIn, you can find that there as well. There's a lot of fun. The team has a lot of fun with that. So definitely check that out as well. But that's us.
Nadine.
Yeah, feel free to reach out on LinkedIn. It's Nadine Timmer-Bodenstein.
And as for me, Benjamin Ensor, you can also find me on LinkedIn, or you can find out what the team's been up to by following 11FS on social media or by visiting our website at 11fs.com. Thank you all so much for listening. If you like what you've heard, please do follow our podcast. Please leave us a review. Let us know what you'd like to hear about in future shows. And if you're listening on Spotify, you can now drop us a comment and tell us what you thought of the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider, or you can even email us at podcast@11fs.com. Thank you all so much, and goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.